We'd like to thank this week's podcast sponsor, Coinbase, a leading online cryptocurrency platform for buying, selling, trading, storing, and staking cryptocurrency. Coinbase is the only major publicly traded crypto exchange in the US, and it's used by millions of users in the UK alone. With a wide selection of more than 250 cryptocurrencies, industry-leading security measures, and a seamless user experience, Coinbase makes it easier to explore the world of crypto, whether you're just getting started or looking to expand your portfolio. To start your crypto journey, sign up through the link in the podcast description. But remember, don't invest unless you're prepared to lose all the money you invest. It is a high-risk investment, and you shouldn't expect to be protected if something goes wrong. Hello and welcome to episode 507 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leach. Damien, how you doing?
I'm good. And one of the things we promised to talk about last week, well, there were two things we said we were going to talk about. One work-related, one personal. I'm going to leave the personal one to next week as another bit of a teaser. But one thing I wanted to talk about on the podcast this week was the viral nature of some of the content we're doing on social media. Now, if you don't follow us on our social channels, first of all, shame on you, but also you're missing out on a lot of great content. So follow us on our Instagram profile, Threads, Facebook, TikTok, YouTube. We do different content across all of those different platforms. So you won't see the same thing on each platform because different platforms lend themselves better to different types of content. And one of the pieces of content that I pushed out last week went viral. And when I say viral, I think the last time I've checked, it's had 1.5 million views. So it just goes to show that we are reaching out on social media massively. I'm putting a lot of work into doing lots of social stuff, not just clips on this podcast. The thing that actually went viral, I'm not going to spoil it because I want people to go and look to see what it was, but it was a meme that I created about a particular topic to do with property that clearly hit a nerve with the UK public and went viral. There's a bit of humour injected in that as well. But I also want to mention another piece of content that's going equally viral for Threads. So I don't really do as much on Twitter, or X as it's now called. I've tend to favour Threads a bit more, and on there I produced 5 single-page summaries, so sketch notes of some of the best finance books that I've ever read. So think of books like Rich Dad, Poor Dad, The Richest Man in Babylon. So I went and created a number of those. It took me a while, but they proved incredibly popular. So you can find those on Threads. And actually I put some of those on Instagram as well. So please do make sure you go on there, but also engage and share, because if you just like or comment on anything we do, that triggers the algorithms and means that our content is much more likely to reach a larger audience and go viral. So if you do nothing else this week and you want to try and support the show in any way, please do go on there and like and share all of our content. There are some of you that do it religiously, but please, the thousands of you that listen to this show, if you all did it every time, then we could have a massive impact, and it would be great for the future of Money to the Masses.
Okay, so let's move on to what we've got coming up on this week's show. Now, normally, Damien, I'd ask you what our 3 subjects are, but this week is a little bit different. We're going to be doing a podcast special on a particular subject, and that subject is property and mortgages. We've done a big bit of research into this, and it's just going to morph into one big piece.
Yeah, so just to give you the backdrop, because of that viral piece that we pushed out on Instagram, it just showed how the UK public, there's a massive appetite for anything to do with property, and particularly buying houses. So what I want to do is do a piece that's going to impact everybody. So the only people in the UK who won't find anything useful in this podcast is somebody who is renting and wants to rent for the rest of their life. So that's going to be very few people, really, because we're going to be talking about house prices, what's going on with house prices, what's going on with mortgage rates, what's going on with 100% mortgages. We're going to be talking about affordability testing that has changed. I'm going to tell you about how to find the best mortgage rate, and also something that I did this week to lock in my mortgage rate early and keep my options open, to do with product transfers and the timescale in which you can talk to your lender. So whether you just have a mortgage, looking to remortgage, looking to buy a house, I am going to be telling you something you probably don't know. So there's a lot to pack into this podcast. So it's going to be quite a pace that I'm going to go through this, but it should be incredibly useful.
Okay, so let's get into it then. You're going to start with interest rates.
So interest rates are probably the one thing that everybody is talking about. Are we going to see the Bank of England base rate go lower, and how will that impact mortgage rate. So the base rate is broadly the rate at which the Bank of England charges other commercial banks and building societies when they borrow money. And as a result, it's kind of like the wholesale price of money. And this headline rate has a knock-on effect to all borrowing and impacts all of us, particularly when it comes to savings rates and therefore mortgage rates. Now, what I want to do is look at the predictions of where the Bank of England base rate is going to be in the next 5 years. Now, these predictions do vary over time, and they actually based upon something called the overnight swap rate. And we produced a chart which I'm going to show you on screen, and this looks at where the Bank of England base rate will be over the next 5 years. Now, we are in the cutting part of this interest rate cycle. If you recall, when inflation got to double digits, the Bank of England hiked interest rates to bring inflation back under control. Now, after that proved successful, we've still got inflation proving sticky. It's not as low as the Bank of England would like. Its target rate is 2%. We are still above that. But the Bank of England is in easing mode at the moment. And we've had a number of rate cuts since last year. And the chart on screen shows you where the market thinks the base rate will be, given different dates when the predictions were made. So you can see there's a blue line there showing you the prediction back in September 24, all the way through to the orange line, which is the current prediction, which is made as I make this particular show on the 2nd of June. Now, the key thing to note is back in September, the Bank of England base rate was predicted to never get above 4%. It was going to be about 3.75%, and then was going to slowly fall and be just above 3% over the next 5 years. That has changed significantly. And as we got into the new year, the market started to predict that the Bank of England base rate wouldn't fall below 4.25%. Then as we moved through the spring, that got cut as we saw inflation come down. We also had concerns about the economic growth in the UK. And as you can see, the Bank of England base rate now is predicted to get to 3.85% by the start of 2026. We will have maybe one or two more cuts before January 2026. Then by 2027, we'll be about 3.68%. We'll then head to 3.75% by early January 2028. And then there it will stay roughly through 2029, slightly increasing until January 2030, when the Bank of England base rate is predicted to be about 4%. The key thing is the predictions have changed over time, and they do change frequently. So you can't base a lot on this. You have to take it with a slight pinch of salt. But what it's showing is that rates are going to be staying higher for longer, or they're predicted to be staying higher for longer compared to just a month ago. That is why we've started to see mortgage rates creep up again. Now, the Bank of England base rate does influence mortgage rates. It's not the only thing that influences mortgage rates. There are other factors as well, but it does have a significant influence on fixed rates. So as we went through the spring, we saw the fixed rates on mortgages come down as the market was predicting the Bank of England base rate would fall in the future and continue to be cut. But now there's been a slight change, and that's because of a number of factors, including the outlook for the economy. The Trump tariffs are impacting this as well, and the outlook for inflation. So mortgage rates are just starting to creep back up again. So moving straight on to what's going on with mortgage rates in the UK. Now, we have an article on the Money to Masses website which we update regularly. We do it twice a week, looking at all the best rates. Now, in recent history, we've seen the best fixed rates falling. But that has started to change in recent days, and we've started to see rates creep back up again. Now, I'm showing on screen the best fixed rate deals in the market. I'm going to come on to the best variable tracker rates as well. But the best 2-year fix at the moment for a 60% loan to value, don't forget your loan to value influences the rate you get. You get the best rates on the lowest loan to values. The best 2-year fix at a 60% loan to value is currently First Direct at 3.89%. For an 80% loan to value, it's 4.14% from First Direct, and the Cooperative Bank gives you 4.46% for a 90% loan to value. Now, be mindful of lender fees. Those First Direct deals that I've mentioned have very low lender fees, about £490. We have seen some really high lender fees in recent months, as much as £2,000. Typically, the fees are around about £1,000. If we're looking at 5-year fixes, then the 5-year fixes at the moment, the best is 3.89% from Barclays at a 60% loan to value. For a 5-year fix at 80% loan to value, then you're looking at 4.19% from First Direct. And Leak United Building Society at 90% loan to value gives you a fixed interest rate for 5 years of 4.38%. Now, those rates are changing all the time, so you have to be mindful. I've given you the latest rates, but they have been changing. Now, in recent days, we have started to see some of the big names moving rates back up, and we're talking about 0.15, 0.2% increases. So if you are coming off a fixed rate deal soon, we're talking about in the next 6 months, you will need to be talking to a mortgage advisor. I'm going to come back to that in just a second. Now, 10-year fixes, I'll just touch upon them for completeness. You get 4.39% for a 60% loan to value, and they're all from Nationwide. Again, 80% loan to value from Nationwide is 4.64%. 90% loan to value from Nationwide is a 10-year fix at 4.99%. It's not a very big market for those. Now, looking at tracker rates, we've got the Bank of England base rate currently at 4.25%. If you've got a 60% loan to value, you are looking at a 4.29% rate as the best in the market. If you're looking at 80% loan to value, then it's 4.29%. If it's a 90% loan to value, you're looking at about 4.69%. Obviously, I'm talking about the best rates you get in the market. And of course, the rate you get depends on your personal circumstances, including your credit history. If you're looking at the averages, then you're looking at about at least a 1% more than the rates I'm quoting, possibly higher. So the average rates aren't anywhere near the ones that I'm quoting. That's why you need to seek advice to try and get the best rates available to you, not just accept what your existing lender is doing. Now, I did mention about shopping around. If you speak to a mortgage advisor, then they can shop around for you, find the best rate based upon your personal circumstances. So when should you look or speak to a mortgage advisor that you can trust? Well, look about 6 months before, start having conversations. It doesn't mean you're going to be able to necessarily lock in a new mortgage rate, but they could tell you what's going on in the market and look at the type of mortgage that might be suitable for you. That might be the difference between a 2-year fix or a 5-year fix or a variable rate versus a fixed rate deal. Now, interestingly, this week, I actually locked in on a deal for a mortgage. My mortgage is due to end, the fixed rate is due to end at the end of September. Now, if you have a mortgage, you have the option of taking out a product transfer with your existing lender. That means that you just move from one deal to another when your deal comes to an end. You don't need to carry out new affordability tests. They don't need to check your income. But of course, it does mean you might not get the best rate in the market because you're getting the rate that your lender is offering. When it comes to talking to your existing lender about a new deal, the time frame in which you can do that depends on the lender itself, so that they have various time frames. Some will allow you to lock in a new deal as far as 4 months ahead of time. Some it's only 90 days. Now, on the Money to the Masses website, we do provide a roundup of the product transfer windows for each lender. Now, you can see on screen that the typical advance period in which you can secure a new mortgage product transfer is 3 to 4 months. Now, with my particular lender, it was 4 months and my deal was due to end towards the end of September. I noted that. I contacted my mortgage advisor that I use, said, look, my deal is due to come up for renewal in 4 months' time. Rates are starting to tick back up again. And what we did is look at the market. My provider had the best rate on the market anyway. So I've locked in a new deal to start when my old one finishes, but in the interim I'm still fully flexible. I could decide to remortgage somewhere else. I don't have to take that product out at the end of my existing deal. If they offer a better rate on a product transfer, I can just switch and get that rate. So the advisor will just switch the rate, or I could, as I said, decide to switch and remortgage with somebody else entirely, in which case I would have to provide new evidence of affordability and income. So what it's done is kept my options open. And at the point now where we are in this cycle, it looks like mortgage rates are starting to creep up, that I may have just caught the bottom of the rates at their lowest point before they've started to creep up again. But my message is that if you speak to an advisor as early as you can, they can look at your existing deal, your existing provider, and the other mortgages available out there and you could keep your options open. So if rates do suddenly rise aggressively in the next few months, it won't impact me because I could just take out that new rate with my existing lender. It goes without saying to make sure that you look at fees and take into the total cost of your mortgage, but your mortgage advisor will help you with that. I will put a link in the notes for those of you who don't have a mortgage advisor that you can trust. It will tell you how you can go about finding a reputable mortgage advisor. Now, I've also shown you on screen, it's important to keep a tab of what's going on in the market. So make sure you compare mortgages. There are various different tools out there in which you can compare mortgage rates, but one of the best ones is on the Money to Masses website, where you don't have to register. You can just check mortgage rates. You put in your details, whether you want a remortgage or you are trying to buy a property. You put in your details and you click search, and the type of mortgage you want, whether it's a 2-year fix, for example, and it will give you the best rate available. You can then filter by overall cost, lender fees, monthly payments. Also, it's worth bearing in mind that the rates you see will depend on whether you're buying a property or just simply remortgaging. The rates are often different. Now, I did mention that we're going through a lot in the podcast at pace. I'm now moving on to options for those struggling to get onto the property ladder. So if you are keen on getting on the property ladder, but you're struggling to save a deposit, or perhaps you feel like your income could be a barrier when it comes to getting a mortgage when you want, there are some positive signs in recent months with a number of lenders introducing zero deposit mortgages. We've also seen lenders offering higher income multiples, and some have relaxed the rules around stress testing, which I'll come on to a bit later. So let's start with the zero deposit mortgages, or 100% loan to value mortgages as they're sometimes referred to. Now, these allow you to borrow the entire value of your home, or the one you want to buy, meaning that you don't need to put down any kind of upfront deposit. So if you want to buy property worth £200,000, then you could borrow theoretically £200,000. Now, these types of mortgages were much more common before the financial crisis back in 2008, but they largely vanished afterwards, with a few exceptions like guarantor mortgages. Now, though, they're making a comeback, which could help those of you who are struggling to save a large deposit, especially when rental costs are so high. First up, there's Skipton Building Society's track record mortgage. That was launched back in 2023. Now, every mortgage I mention, we do have reviews of on the Money to Masses website. There'll be links to those in the notes. Now, this particular product was designed for renters who can show 12 months proven track record of paying their rent and bills on time. The maximum loan is £600,000, and the loan to income multiple is typically 4.49. No, it can go up to 4.75 for those with incomes over £50,000. Then we have April Mortgages, who launched their 100% deal in May 2025, so it's a brand new deal. They offer 10 and 15-year fixed deals, which are open to both first-time buyers and home movers, with a minimum household income requirement of £24,000. The maximum loan to income multiple is 4.49 times income, and the fees are around £1,200. And another new entrant is Gable Mortgages. They've recently launched 2 5-year fixed deals. One for standard properties, and a slightly lower rate is on offer for new build properties. Again, they've got a maximum loan to income of 4.49 times, though they say they'll go up to 5 times the income for key workers. But a word of warning here, their fees can be quite high, ranging from just over £2,000 up to nearly £10,000, depending on the property price, and these cannot be added to the property price. You're going to have to pay that fee up front. It's important to note that these deals often come with very specific eligibility criteria. So Skipton, for instance, need that rental history. April Mortgages has that minimum income, and both April and Gable Mortgages are currently only available via mortgage brokers, meaning that you can't go to them directly to secure a deal even if you want to. So as you can see, there's been a lot of change in recent weeks in this portion of the market, which is good news for people who are wanting to get onto the property ladder. There's also some changes on things like April Mortgages, where they're allowing unlimited overpayments without incurring early repayment charges. Again, that's something that's quite novel to see. Now, of course, I've got to mention some of the cons about these types of mortgages. Obviously, the rates you get are typically far higher than if you are able to put down even a small deposit of say 5%. So for instance, Skipton's 5-year fix at 100% LTV is 5.37% as I make this. If you compare that to Nationwide, who at the same time are offering a 5-year fix at 4.83% for those with a 5% deposit, that's a big difference, and it'll have a significant impact on your monthly repayments. It goes without saying there is that negative equity risk. So if you take out a mortgage that's 100% of the value of the property that you're buying and the property falls in value, then you will owe more than the property's worth and you will technically be in negative equity. Now, the other thing I would say is the high fees. Look out for those. Some of the products do have relatively high fees compared to others in the market. So Gable was one of the ones that we've already mentioned. So do bear that in mind when you're looking at these products. And one for the future, when you come to the end of your deal and you've taken out one of these 100% LTV mortgages, then you might find it hard to remortgage if you've not built up enough equity in the property. So if the house price hasn't risen or you haven't managed to overpay in any way, then you will be limited in your choice of products when you do actually look to remortgage. I'm going to focus now on the changes to affordability criteria from lenders and the amount that they will lend to you. So focusing first of all on income multiples, there has been some positive changes in recent months to that as well. Now on screen, you'll see an article about how much can I borrow on my mortgage, which is from the Money to Masses website. What we do is we give a roundup of the income multiples that various lenders will offer. Now, looking at the table on screen and running through it, you can get from Nationwide 6 times salary. There are eligibility criteria for each of the ones I'm going to mention. I'm not going to run through all of that criteria, but for example, with the Nationwide one, it's available on 5 or 10-year fixed rate mortgage deals only. That is something you'll see on some of the highest multiples. There is another lender, actually, April Mortgages, who allow 7 times salary, and they have a similar caveat where you have to borrow for a long term. So they have a 10-year or 15-year longer term fixed rate that you have to borrow at if you want that 7 times income multiple. But for Nationwide, it's 6 times. Atom Bank also give you 6 times salary. They don't have that long-term fixed criteria, but they will give you a maximum loan to value of 90%. Then you've got Leeds Building Society at 5.5 times salary, Lloyds Bank at 5.5 times salary, Halifax is the same, as are Santander, Metro Bank, HSBC, Barclays and NatWest. Some lenders only allow the higher multiples on what are known as professional mortgages, so those are mortgages that are available to certain workers. It could be things like dentists, barristers, or people who are key workers. So that's some of the caveats there. When it comes to the higher income multiples, the natural question is, does that apply to 2 people if they're applying for a joint mortgage? The answer is yes. So if you're applying as a joint mortgage as a couple, then it will multiply both your salaries by that factor of say 5.5 or 6. So that will increase the amount that you can borrow together. Moving on to stress testing. In addition to higher income multiples, several of the UK's largest mortgage lenders have actually relaxed their stress testing rules after the FCA expressed concern that the way that some lenders are currently applying stress tests might be unduly restricting access to mortgages for people who could otherwise actually afford them. So Halifax, one of the UK's largest lenders, made significant changes to its affordability calculations in April this year by reducing its stress test rates. A typical household with an income of £75,000 could potentially see their maximum borrowing capacity increase by as much as £38,000. Similarly, in May, Nationwide Building Society announced it was reducing its affordability stress rates by between 0.75 and 1.25 percentage points. Now, that means the average mortgage applicant could borrow around £28,000 more than previously. So these changes to stress testing will benefit everybody. And so what's important is, just because you may think that a couple of years ago when you took out a mortgage that you didn't have as many options and you won't be able to afford to remortgage elsewhere, you may be able to remortgage elsewhere. So you don't have to just take a new product with your existing lender via product transfer. you may be able to get a better rate now because of the increase in multiples or the changes to stress testing and affordability testing with lenders. So do make sure you seek advice so you can shop around. You may be able to reduce your mortgage rate more than you had previously thought that you could. So the big question is, what's going to happen to UK house prices in this year and going forward? Now, we have an article on the Money to the Masses website with that exact title where we analyse the past data in terms of the house price indices that are published to give an idea of where the market could be going. Now, the article is on screen for those who are watching this. And the first thing you can see is the UK house price index, which is the first index I'm going to talk about. Now, this is based on actual completed sales. So that's both cash sales and those with a mortgage. And it's considered the most accurate information that we have, though it does have a bit of a time lag. So for March 2025, there's the time lag because we're in June now. In March 2025, it showed the average UK house price at £271,000. That's an annual change of plus 6.4% and a monthly rise of 1.1%. Moving on to the nationwide house price index. Now, this is based upon Nationwide's own mortgage approval data, and it's reported that the average price is now £273,427 for May 2025. So the data is much more current. Now, that represents an annual change of plus 3.5% and a monthly increase of 0.5%. Moving on to the Halifax House Price Index, that's also based on in-house mortgage data, and the data shows for April 2025, so it's a month earlier, that the average price is £297,781, but more importantly, the annual change in house prices was 3.2%, but there was a slight monthly fall of 0.3% there. So you can see it's a bit of a mixed bag. Now, the final index I'm going to talk about is Rightmove. So the Rightmove house price index, that's actually based on asking prices on its portal. So this gives you more of an idea of what sellers are asking for their houses, not actual transactions. So for May 2025, the average asking price was £379,517, but the annual change was 1.2%. So it's lower than the others with a monthly rise of 0.6%. Now, if you want a breakdown of all the monthly changes, you can look at the article on the Money to the Masses website or what's on screen, but I've given you the high level figures, and the takeaway is that, as I've mentioned, Rightmove is about what sellers are hoping to get. Nationwide and Halifax are actually using prices that are based upon mortgage approvals to get their indices. And then, of course, we have the UK House Price Index, which is based upon data from house completions. But what's interesting is that Rightmove's asking prices are significantly higher, yet the reported annual growth is lower than the completed sales from the UK House Price Index, or even the mortgage approval data from Nationwide and Halifax. Rightmove themselves even noted that the record house prices that they're showing for May seem to be driven by seasonal factors, and that new buy demand has actually slowed down. Now, this gap between asking prices and what properties are actually selling for can tell us something about the market. So asking prices reflect the optimism of sellers, or perhaps their initial ambition, while completed prices, on the other hand, reflect what buyers are actually willing and able to pay after all the negotiations taking place. And when that gap widens, it can indicate that the market is cooling off, or that buyer affordability is becoming a real constraint, forcing sellers to be more realistic and accept lower offers than they might have initially wanted. In fact, Rightmove suggested that the latest price increases are the lowest for 9 years, meaning the current market favours buyers, so it's a buyer's market, and is more subdued than usual. So for buyers, the message seems to be, don't necessarily take asking prices at face value. There's likely to be plenty of room for negotiation than there has been in more recent times. And for sellers, it means you need to be more realistic with pricing from the outset, especially if you want to push the sale along and attract some serious interest. Anecdotally, I can tell from people I talk to in the market, so not just people who are buying and selling homes, but people who are agents, that is pretty much what they're seeing on the ground. So the market is evolving. So there you go, that's our mortgage house buying special. So in summary, interest rates are falling at the Bank of England. Mortgage deals were becoming more competitive, but we're starting to see some rates ticking back up. So do make sure that you are mindful, shop around, and do look to possibly lock in, speak to a mortgage advisor. Always look at total costs, including fees. Those 100% mortgage deals are coming back on the scene, and they give a potential route for some, but they come with significant caveats. Higher income multiples and relaxation of affordability rules could help some buyers, but don't expect miracles. And as for house prices, well, they're a mixed bag, but if you negotiate hard, you could get a good deal if you're buying. But if you're a seller, then you do need to be realistic about the asking price.
Yeah, so I've taken even more of a backseat than usual on this week's podcast, Damien. I have been doing stuff in behind the scenes, making sure that everything's looking and sounding nice. But as always, I feel like I need to say something here, Damien, just to be a part of this podcast. But as always, the best thing you can do as listeners is stay informed. And you can do that by checking out everything that we do at Money to the Masses. Check the articles that Damien's mentioned there. We'll put them in the show notes. And of course, I'll link in the show notes exactly how you can get in touch with a mortgage advisor if you don't already have one. And you can search for mortgage advisors based on location or also by rating as well. So all of those details will be in the show notes.
I know I feel a bit self-conscious there, Andy, because I kind of went for it and told everybody everything that I could in short fashion on the property market. But maybe next week, this is something that I want to bring to the podcast, is that Andy makes me laugh every week about his bowls that he does, and he'll probably cut this out, but the bowl scene, lawn bowls, there's a lot that goes behind the scene in terms of some of the gamesmanship from the people he plays against. It just tickles me, and I want to always bring it to the podcast, but Andy never lets me. So maybe if enough of you sort of write in and say, yeah, let's hear Andy's bowl stories, they'll be anonymous, then we'll bring them to the podcast at the start of each show. As ever, please do get in touch if you've got any questions, topic suggestions. Do follow us on all our socials, as I've already said. Please give us a review. I feel like giving out some Money to the Masses mugs. We've got some still in the Money to the Masses towers that I could give away. So do leave a review on your app of choice that you use to consume your podcast. And I think, Andy, all that's left for us to do is to say until next time.
Until next time.